Hi, welcome to this week's edition of the weekly wrap up. So, the week gone by was a -1 for the Indian markets, with the Sensex and Nifty ending the week low by about 1.2 to 1.3%. Indices representing mid and small caps declined in the similar range as well from a week ago. When gauged from a month ago, the small cap index is up by about 3%, while mid caps are higher by about 1.5%. In the same period, the Nifty 50 and Sensex are low by about 1.5%. Amongst the sectoral indices, defensive sectors such as FMCG, healthcare, pharma were amongst the favored lots this week, with their benchmark indices up by about 2.1 to 3.8%, while weakness was seen in names from the realty, banking, and financial services spaces. One key development in the week gone by was that of the US Fed increasing the interest rates by about 75 basis points for the third time in a row as part of its battle against sticky inflation levels, thus compromising growth to tame prices. With a 75 basis point rate hike, the benchmark policy rates lie in the range of 3 to 3.25%, which are the highest levels seen since the global financial crisis. The Fed further reiterated its firm commitment to fight inflation and aim to push it under the 2% mark, stating that its forecast range for policy rates to rise to 4.4% in 2022 and 4.6% by 2023. In other words, the Fed is quite hawkish in its stance. As a result of this, the estimates for economic growth for 2023 and 2024 have been marked down to 1.2% and 1.7% respectively on the back of a tighter monetary policy. In addition to this, IT major Accenture announced the results yesterday. The results were decent and broadly in line with its guidance. As for the outlook for the year, the company has provided a good outlook with 8 to 11% growth envisaged in local currency, and the current demand scenario is seemingly sustainable amidst the discussion of slowdown and recessions. While this could have a positive rub-off effect on the Indian IT pack in the short term, the broader concerns over the slowdown in the US and the narratives that emerge from the developed parts of the world would have a long-term bearing on the IT pack, which has been in a correction mode ever since the signs of a slowdown and possible recession have emerged. The IT index, for example, is down by a third from its 52-week high as compared to the Nifty 50, which is down in the mid single digit zone from its yearly highs. As a result, the expectations and the earnings multiple have contracted considerably over the past year. While the 1 year forward multiples of the two largest players are yet to reach their pre-COVID levels, the valuations of the next three players have come close to their pre-COVID levels. But this raises a question whether we are close to the bottom. It gets tough to gauge as history shows that in dull times these stocks have traded at low valuations. But another way to look at things is, and to get a sense of the bottom, is to look at the free cash yields of these companies. Going by the market's expectations, valuations of select names from this sector on this metric are not very far from their higher band that we see on a historical basis, as can be seen from the chart. So we will keep a constant check on these metrics in the future and keep communicating through our various communication means. So that's it from us for this week's edition of the Weekly Wrap Up. Have a great weekend.